U.S. pressure on Chinese stocks looks set to accelerate the growth of capital markets in Hong Kong and mainland China, as investors remain intent on chasing opportunities in the world's second-largest economy. Congress is mulling a new law that could force Chinese companies to delist their stocks from American exchanges. The move builds on existing U-China tensions, which began in earnest 2 years ago on trade, and have since spilled over into technology and finance. In mid-May, President Donald Trump's administration told a federal pension fund to halt investments in Chinese stocks. Revelation in April of major fraud at Luckin Coffee, which sold itself as a rival to Starbucks in China, accelerated concerns about lack of transparency into Chinese companies. Luckin poisoned the well, said Blueshirt managing director Gary Dvorchak, who advises Chinese companies interested in listing in the U.S. I foresee a very, very difficult environment. At the same time, major international stock and bond index managers have started to include mainland Chinese assets, following years of observation. The inclusion automatically adds some Chinese stocks to many investment funds. Money managers looking for long-term growth opportunities have increasingly turned to China even before the coronavirus pandemic shocked global growth. COVID-19 emerged late last year in the Chinese city of Wuhan. It has since infected more than 7.3 million people, and killed over 416,000. The outbreak stalled in China by mid-March. Economists expect the country to eke out growth this year, while they predict developed nations like the U.S. will contract. The Asian giant is also home to some of the largest technology startups in the world. To deprive investors from great growth companies is a big mistake, and it will have a meaningful effect on the U.S. financial market, Brendan Ahern, U.S.-based chief investment officer at exchange-traded funds manager KraneShares, said in a phone interview last week. More investment bankers in Hong Kong, more lawyers, more traders, it will have a true impact on the U.S. finance sector, the New York metropolitan area as a financial hub for U.S. capital. The New York Federal Reserve found that the U.S.-China trade war reduced the market capitalization of U.S.-listed companies by $1.7 trillion, with further hits to investment expected this year, according to a study published in late May. In April, allocation to Chinese assets among more than 800 funds held steady from the prior month at almost a quarter of nearly $2 trillion in assets under management, according to the latest data available from EPFR. The data covers 9 categories of stocks listed in mainland China, Hong Kong, Taiwan, the U.S. and Singapore. Chinese government restrictions on cross-border capital flows have made it difficult for foreign funds to access domestic markets, making Hong Kong a more attractive option for international investors wanting to tap China.